Hello, everybody. I wanted to provide a step-by-step verbal explanation of our financial planning guide to help dentists go through this experience of COVID-19 and the financial hardships that they're experiencing, and create ideally clarity around the step-by-step process that they can be taking right now to address their financial needs. So this is a document we put together, put a lot of time into this to answer so many of our clients' questions, a lot of them resulting from webinars we've done and just daily questions about the coronavirus legislations that have come out and how that applies to them and what they should do with their team members, how they conserve their cash, and just how do they survive and come out of this ready to resume their practice operations. And so I'd like to walk through this and explain it in good detail and try to answer a lot of the questions that you will likely have as you read it yourself. And just at the top, a little bit about who we are, since we know there will be a number of people who are not current clients wondering, I'm sure, who is Practice CFO. Practice CFO, well, we exist to help doctors thrive financially, and we do this by integrating their CPA, financial planning, and retirement plan services. And the outcome is greater financial organization, peace of mind, and accelerated financial independence. And it's a different model than most CPA and accounting firms. It's really an end-to-end model that plugs the holes of disjointedness, which are often created by having multiple advisors. So this guide is intended to give our clients and other dentists, one, an understanding of the recently passed coronavirus legislations, and two, a step-by-step process to determine the appropriate course of action for their practice. There's our contact information. We have about 22 people at our firm. Here are the 5 CFO advisors who are working directly face-to-face with you, our clients, and we do so on a regular daily basis. Okay, a little caveat down here. We are not a law firm. Please consult with a labor lawyer for guidance on the labor laws of your state. And this guide is our best understanding from the research that we've done, particularly our research of the new legislations resulting from COVID-19 pandemic. There's 3 of them. I won't list them off here. You can read that. Additionally, please note the government and banks are currently working to administer this new legislation. Today is Monday, March 30th. The legislation, the most recent and significant, was the CARES Act. That was passed on the 27th, which was Friday. So literally we're about 1 business day out from the passing of that legislation. So consequently, there may be some level of uncertainty in the steps in this guideline. We are presenting it to the best of our knowledge as this continues to unfold. Let's start off. Step number 1. So this is a 10-step program. And in the first step, what we're recommending you do is step back. And we know there's various loans out there. We know that the government is trying to get money in your pocket to help support the economy and support small businesses and individuals. But step back for a second and let's try to identify how much cash do you actually need. Let's not just run to the SBA or run to the bank just because we're in a crisis and we're nervous about it. Let's try to be methodical and define what our cash needs are first. So that's step 1. Determine the minimum amount of cash you need to get through the next 6 months and define your target loan needs. Now, the office certainly is going to open up, hopefully, before 6 months from now. However, there may be some reservation from patients in resuming, even if you can start, let's say, back up May 1st. And so we want to do a 6-month projection here. And we don't know, as it says here, we don't know how long before authorities will allow us to resume operations. However, we recommend you determine a target amount of funding from the EIDL or the EIDL, the Economic Injury Disaster Loan, which we've all been, talking about, the SBA 7A loan, and any general lines of credit that you have. We recommend determining the cash you'll need in the 4 primary areas over the next 6 months: facilities, debt service, payroll for skeleton staff, and your personal budget. Clearly, you have more expenses than those, but those are the largest. And in making this calculation, reduce the totals by the amount of rent abatement and loan deferment that you're receiving. This resulting sum is what I'm calling your disaster cash. Add to that your standard working capital needs to arrive at your total cash needs. Subtract from that the cash you have on hand, net credit cards, to determine how much disaster loan money you should be requesting in the aggregate. So below is an example. Let's look at this. A sample client, facility cost per month, $8,000 in rent, and debt service, $9,500. Skeleton staff, we'll talk about that, but that's basically your minimum staff needed during office closure. And then what your personal budget is to cover living expenses. And then what we recommend is we plan for 6 months of facility and debt service and 3 months of your skeleton staff and personal budget. And so if you multiply that out, you will get to a target reserve required. However, subtract out from that the amount of abatement or loan deferment that you're going to get. In facility costs, you might get something. I'm finding most people are not. And a quick comment on facility costs is you should ask, because you don't ask, you don't know if your landlord is willing to abate your rent or provide some support to you. Some will, many won't. Some that will caveat it and ask for an adjustment to your lease agreement. They might ask you to extend the term of your lease. They might take whatever deferment you do and tack it on little by little in your rent payment in the subsequent 12 months after we come out of this. Either way, it's a good idea to ask them. Be very careful about this because lease agreements have provisions in them, and some provisions could be triggered and have negative consequences to you. So our advice is definitely talk to your attorney on the lease agreement if you're going to not pay. Debt service, most banks are lending a generous hand, giving 2 to 3 months of deferred loan. Some are requiring that you pay the minimum of interest. Others, it's just a full deferment as well. So subtract out whatever support you're getting from landlord and the bank to come to your required reserve. So 8,000 times 6 months, 48,000 less 16,000 equals our 32,000. There's our debt service 28, our skeleton staff, that's 8,000 per month times 3 months equals 24,000. And our personal budget of 10,000 times 3 months equals 30,000. So you add up this column right here and you have a total of 114,500. Now, normally in any given month before all this happened, you might have a target working capital need, a cash cushion. And let's say that that's typically 60,000. That helps you feel comfortable getting through the fluctuations month to month of your collections. So you add that up to your disaster cash and now you have your cash required, $174,000. And we're going to subtract out from that what cash you have on hand, netting credit card. So let's say you have $100,000 cash, but you got $20,000 in credit card. Your current cash on hand, really your true cash, is $80,000. And from there, we will subtract out the cash required from the cash required of 174 to get us through these next 6 months. We're going to subtract out the cash we have on hand, which is 80, which leaves us with the minimum loan proceeds goal. In other words, this is the amount of loan that we are targeting, either from solely the SBA 7A loan, SBA 7A loan plus a line of credit that you might have with a bank, or the 7A loan plus the EIDL loan, which you could be applying for right now with the SBA. And I'll talk about here in a moment which ones you should be applying for and perhaps which one you shouldn't be applying for. So action step here is to apply that same algorithm or process to your own numbers using your financial statements. If you're a client of practice CFO on the financial statements, we have a very specific total on your profit and loss. You can look at your 2019 financial statements in your portal, and in the year-to-date section, which is January through December. You could look at the total facility cost and just divide that by 12, or you sort of know what your rent is, throw on your utilities perhaps, and you have your monthly amount for your facilities. Debt service, you should know what that is as well. Your skeleton staff, I have a step later where you're deciding what to do with your staff, but determine the pay levels for the staff that you're keeping on to support you through emergency services and scheduling and billing during the office closure. And then lastly, if you haven't done a budget, periods of financial crisis are a great time to do a budget, to be introspective about the way you're spending money, your relationship to money, and I highly recommend doing a budget right now and add that there. And then add in the amount that's been being deferred or forgiven or abated there in the next column, and then just do the math. And you can follow the math through to come down to what is the minimum loan proceeds goal that we're looking to get from available resources out there. Okay, so now we know our minimum loan proceeds goal. We'll go ahead and use this example, 94,500. We'll say somewhere around 90,000 is what we're targeting. Step number 2 is apply for the economic injury disaster loan, the EIDL loan, which will include a request for the emergency grant of $10,000. Now, I want to caveat that really quickly. And let me caveat that, and I believe I have it here. If your cash on hand can't float you until you resume operations or receive the 7A loan, we recommend you apply for the EID loan, the Economic Income Disaster Loan, and also the grant. Many of you have already done this. Okay, let me pause there. I don't want you to take on debt just to take on debt. I want you to take on enough debt to get you through this period, and then you get back into the pattern of building financial security. And if you have enough cash on hand to get you through the period of time when you can get the SBA 7A loan, which I'm going to highly recommend you get because it's essentially free money, then you don't need to take out the EIDL loan. The EIDL loan is not forgiven. You have to actually pay that back. Now, there's no prepayment penalty on it, and the terms are very good. They're under 4%, and I believe it's a 30-year repayment penalty on that. They're very good, but again, don't take out debt just because you can. If you don't have enough cash to get you between now and around the end of April, beginning or mid-May, then you should take out the EIDL loan. Otherwise, you're going to be getting the 7A loan most likely sometime in the beginning of May to the end of June. The end of June is the last, June 30th is the end of funding. If you don't get funding by June 30th, you don't get funding for SBA 7A loans. So if you can't get enough cash to last for the next roughly 4 to 6 weeks, you should probably take out the EIDL loan. Now, the EIDL loan, if you've already, as of today, Monday, March 30th, if you had already submitted for an application before today, you used their old application system, which was a fillable PDF, and you sort of dragged and dropped it into this Dropbox, I believe, square on the SBA website online. They completely changed that today. And it's a dramatically streamlined process. It literally takes about 15 minutes, even less when you fill that out. So go ahead and do that. I have a link in here, down here at the bottom, to complete this application. You just click here and it'll open up. Let me just show you briefly what that looks like. It has where you indicate your disclosures, business information, business owner information, additional information, and summary. It's not asking for debt. It's not asking for assets. I mean, it doesn't get more simplified than this. You'll simply click, you have less than 500 employees. You can check all the following that apply here. Basically, you're not committing fraud and illegal activity and things like that. And once you go through this, you'll find it's very straightforward to then include the business legal name. Your trade name is your fictitious name. Many states, it's going to be the name of you, your name, Wesley W. Reed, DDS, for example, and then your trade name might be San Diego's best dental practice in the world, and you put that there. And then you put in your the EIN actually for your business, or social security if you're a sole prop. Most of you are going to be S corporations or sole proprietors. You'll put that in there. You're not a nonprofit. You're not a franchise. And then really, you see these reds, those are the only ones that are required. Gross revenue over the past 12 months, that's going to be really, you could pull up your December 31st financial statements and just use all of 2019. Or if you want to be more precise, you could do February of last year through January of this year. I guess that's what they're saying here, but I'm sure if you put in just the 12 months of 2019 for ease of accessing that information, that would be fine. And then you could really leave all this other stuff blank if you're not in the business of doing rental properties, nonprofit. A lot of this stuff doesn't apply. This says combined annual operating expenses prior to the disaster for all secular social services. So this doesn't relate to you. Then you come down here and you'll put in your address, state, etc., the business ownership details, and then you'll click next. I'm not going to fill this out, but really the only question on the next page is they ask you, what are your COGS? What are your cost of goods sold? Cost of goods sold is an accounting term. Let me come back to our guide. Cost of goods sold is an accounting term that represents the amount you paid for inventory. Well, you're really a services company. I know you have handbags with some toothbrushes and all that stuff, but really you don't have cost of goods sold. You're not selling products and managing inventory. So technically your cost of goods sold are zero. However, sometimes the government isn't terribly clear about things, and that might be asking for what's your overhead, which would be your payroll, lab supplies, facility, marketing, and admin. And so we actually don't know. So we're generally recommending people put zero, because literally the term cost of goods sold is inventory, which you don't have. Secondly, it doesn't state somewhere, but I believe that the amount you are eligible for has to do with what is your what's called your gross profit margin. And gross profit margin is your revenue less your cost of goods sold. And since you don't have cost of goods sold, it's simply your revenue, which is your collections. So I probably wouldn't put in there what is your profit after expenses. I would actually put your collections in there. Now that doesn't matter if you've already submitted this and you put your profit instead of your revenue. Just you can talk with the SBA when they contact you, which they should be doing to issue the loan, and you can make a note of that and clarify it then. Or if you don't get a large amount here, really remember, all you need is the amount needed to get you to the point when you apply and receive the funds for the SBA 7A loan. So not the end of the world if the loan is $15,000 or $20,000 instead of $40,000, as long as it's enough to get you through that period of time. Be sure to check the box. I would like to be considered for the $10,000 grant. And comment on that is, yes, it is free money. Even if you're eventually denied for the EIDL loan, it's free money, that $10,000 grant. But keep in mind that you also know the 7A loan, which I'll talk about a little bit later, a separate loan, can be fully forgiven if you maintain your employee levels and employee compensation. So I'll clarify that. But my point is that if you take this grant, you don't have to pay it back, but it will reduce the amount of SBA 7A loan that is forgiven later. In other words, the total amount of loan forgiveness is going to be the same to you, whether or not you get this grant or not. So if you don't apply for this or you don't get the grant, don't be too concerned as long as you're applying for the SBA 7A loan, the free money loan, and you're going to get that loan forgiveness there. I hope that makes sense. And then you include your direct deposit information, and from what the SBA website says, 3 days afterward, you should receive, business days, you should receive the $10,000 grant. Now you cannot use the EID loan proceeds for the same expenses as the 7A loan. So if you get the EID money and it's in your bank account, then you get the 7A loan later, you can't really be using that to pay for, say, the same, same rent. I don't know how the SBA is going to capture your accounting records on that, because really the money just goes into one pot, and then some dollars go here and some dollars go there. My thought is you're going to probably be spending on some basic expenses just to even being in sleep mode while your office is closed, between now and the time you get the 7A loan. So you'll probably end up spending the EID grant money or the EID loan before you even get to the 7A loan. All right, I'm going to skip down here. Yep, I already explained this. And again, there's the link to apply for the loan. So that is step number 2, applying for the EID loan that comes with the grant. On to step number 3, decide what to do with each employee during office closures. So the reason why I wanted you to do the grant first was if you're predicting that you don't have enough cash to bridge you to the 7A loan or to bridge you when you open up operations again and start collecting money, you want to get that going right away then. So now on to step number 3, decide what to do with each employee during office closures. We recommend you consult with a labor attorney. We are not labor attorneys here. However, being accountants, we address these questions all the time. And so here's to my understanding, again, qualifying that a labor attorney should be consulted here, so I don't get any trouble. You need to make a decision on what to do with each staff member individually. You have the following options and can use them on a staff-by-staff basis. It's not all or nothing. Number 1 is you terminate them. Use this option if you permanently wish to terminate a staff. So many of you in many states, particularly California, can often be worried about wrongful termination or just possible litigation afterwards, after termination. This is one of those periods of time where you can just say, hey, I'm terminating you because the business cannot sustain you at this time. And we don't need to provide any explanation. I believe the court system would understand that you had to just let some people go to get through this period. Pay them out their final paycheck, including accrued vacation, and in some states, accrued sick, which is not required in California, accrued sick. Accrued vacation, yes, not sick. Some states require accrued sick to be paid out. Give them termination documents. Consult a labor attorney for proper termination procedures and documents. Note that paying out vacation and or sick in their final paycheck does not prevent them from being eligible for unemployment income. They can file for unemployment and will be fully eligible. See the sidebar over here, down here for the amounts that they're eligible for. Let me comment on that real quick. It's really important with your staff that you communicate a game plan with them. And it's not that you're insensitive here or heartless in letting them go or going on furlough in option 2, which I'll talk about in a minute. It's just that you can say, hey, right now I'm paying you X. For the next 3 months through July 31st, the government is essentially replacing all or a good portion of that, because if you're fully unemployed, meaning you don't have any income, California is going to pay you $450. Some states it's a little bit lower. Some states it's a little bit higher. And the federal government, as long as you get, to my understanding and my research, as long as you get $1 of state unemployment income, then you'll get the full $600 of federal income, which is distributed through the state, by the way. So in California, that's $1,050 per week, an average of 4.2 weeks per month. 1050 times 4.2. That's almost $4,500 per staff. Now in California, they had to have been making right at about $4,000 a month to qualify for the full $450 per week of eligibility there. So that's a healthy amount. Plus, they're going to be receiving, as you can see down here, $1,200 per adult in their home and $500 per child if their income is under a certain level, which if they're single, filing their tax return single, they're going to get, if they earn under around $75,000, they're going to get that full amount. It's phased out up to about $100,000, then they don't get anything. If you're married filing joint, it starts around $155,000 to $170,000 that it starts to phase out. So if they make under that amount, they get the full $2,400 for the parents and then $500 for each child. And once you get up to about $200,000, that phases out. What's my point? Your staff are going to be pretty well taken care of during this period of time by Uncle Sam. So you don't have to feel terribly guilty for furloughing them to sustain the viability of your practice during this time. So communicate with them what there are, maybe point them to the Department of Labor website. There's a lot of fraudulent Department of Labor gimmicks out there, so be really careful about the website that they're going to. So let's go on now to option 2. You can put them on furlough. So these staff still remain on payroll as current employees, but with no current hours or pay. Putting somebody on furlough isn't something you sign or a document. It's just the default of what's happening just by virtue of them not having hours and not working, but not being fired at the same time. So no final check is required. These employees will be fully eligible for unemployment. That's an unusual circumstance due to COVID. Normally, if somebody's furloughed, they wouldn't be eligible for unemployment, but in this case, they are. So use this option for employees you wish to resume once operational. But furloughed employees are ones that really are not a part of your skeleton team. That's option 3. Keep them on payroll. Staff remain on payroll and continue to receive base pay on hours worked. This will constitute your skeleton staff. For salaried employees, determine the appropriate hourly pay rate and pay by the hour. Most states allow unemployment income for reduced hours. However, unemployment income is phased out if their earnings are too high, generally around $400 to $1,200 a week. In California, if you pay somebody $600 in a given week, that makes them ineligible to receive unemployment income for that week. Keep in mind, your staff have to recertify weekly with the Employment Development Department to get their unemployment income. What I would say is have staff do what you need to do to have some income coming in and to be taking care of your emergency cases. I wouldn't say try to force somebody to not work just so that they can be eligible for payroll. Take care of your practice first. That's the heart of all the cash flow for both you and your team. And then whatever the outcome is from an unemployment income to your employees, let that be the case. Use this option for employees you need to perform emergency treatments for patients or handle administrative tasks during the office closure. Okay, so here's your action step. List out your employees, identify whether they are terminated, furloughed, or a part of your skeleton team, and then make any notes, make sure you communicate with them and make any notes that might be helpful to you as you do communicate with them. Question, could you go on unemployment? Technically, yes, you could, and actually make perhaps a decent amount there. But in most states, if you're working, even if not earning money, that would disqualify you from receiving unemployment income. If you're an S corporation and you're transferring funds to your personal account, that may, and I put may, disqualify you. I can't find where the law is clear on this. If you're taking a distribution of profits, seems to me that substance over form, you're likely getting paid if you're pulling cash out of the practice to live on personally, and that could disqualify you. Also, the amount you'll likely receive may not be worth all the work involved, the paperwork, weekly recertification, etc., and it may increase your unemployment insurance rate, which applies to your full payroll. So you'll end up likely paying more in unemployment insurance each year for potentially years by increasing your unemployment income. Question has often been, are my kids eligible if they were on payroll for unemployment insurance? And I don't know. Depends on the state. I actually don't know. So consult with a labor attorney on that one. My thought is if they're really not working in the practice and that was a tax planning strategy, which is it's a good strategy, really, I mean, ethically putting them on unemployment income just doesn't sound or feel right to me. All right, step number 4, conserve your cash. Cash is like water in the desert during financial crisis. So here's the action plan, step number 4. Furlough your staff members or terminate them. We discussed that. Number 2, for practices established as S corporations, adjust your payroll by either removing yourself entirely from payroll or eliminating all federal and state income tax withholdings. Note, for our clients, we've already reviewed each of your payroll structures and made adjustments to reduce your payroll to the minimum required amounts to meet your living budget needs and to fund your 401k. For most of our clients, we are trying to tell you to keep funding your 401k. This is the best time to be doing that, but including the safe harbor profit share portions. And if you have a defined benefit plan, funding that as well. Now, if you can't do that, I mean, I'd almost rather see you take out the EIDL loan than stop funding your retirement plan through this period of time. But that could be a last resort to pull that lever and stop funding your retirement plan if needed. Avoid making any quarterly estimated tax payments. Delay paying the 2019 taxes owed until 7/15. There's no penalty for that. Now, request a deferment on your bank loans. Most banks are offering them. Talk with your attorney about requesting an abatement on your rent. We spoke about that. Avoid paying vendors that aren't giving you direct support through this crisis. We like to think that Practice CFO is. We certainly are interacting with virtually all of our clients on a real-time basis and putting all of this together for you. We are all working overtime over here. We are, however, deferring our tax fees for 6 months. As a last resort, you can stop funding your retirement plan. We spoke about that. Consider offering a discount to your patients if they prepay for treatment now. One of our clients did that, thought it was a great idea. Note that federal direct student loans are receiving a 6-month automatic deferment of payments through September 30th, 2020. If you're not seeing that, contact your loan servicer. Check your city's website for financial aid programs available. For example, the city of San Diego had one. It, I think, is now turned off and got used up, but you could check in your different cities if they have some local grants. Step number 5, start scheduling your patient appointments, even if you don't know when you'll resume operations. That may mean you need to cancel if you schedule them too soon and you can't open back up, but it's worth the effort. You want things back in action as quickly as possible when the authorities allow it. Wayne Gretzky said, he's one of the hockey greats. I'm a huge hockey fan. I skate to where the puck is going to be, not to where it's been. So that concept applies here. Think about where the puck is going and you want to be skating in that direction. So communicate with your stakeholders. That's your patients, that's your team, that's your lenders, that's your CPA, etc. Schedule aggressively with your patients. Action steps, use your skeleton team to be reaching out. I would send out a letter to your patients outlining your office procedures to maintain clean, sanitized office with the highest level of sterilization procedures. Help them feel comfortable to come back. Personally, very few doctors do this, I find, yet I think it's such a great idea. Personally reach out. I know that's possibly a lot of phone calls, but hey, you could be at home watching Netflix or you could be calling your patients. Personally reach out to your patients to check in on them. Discuss their last treatment and see how they are doing. Discuss upcoming treatments and your plans when the office reopens. In other words, stay connected. Great quote is, never let a good disaster go to waste. This is an opportunity for you to really build goodwill with your patients and your team, in spite of having to furlough some of them. Let them know you care and you're doing your best. Also, communicate regularly to your staff members to keep them informed. So we spoke about that. On to step number 6, applying for the SBA 7A loan shortly before you're permitted to resume operations in your state. This is really important. We recommend our clients and dentists generally apply for the SBA 7A loan. It's virtually free money if you resume your staff at the time immediately when you receive those funds, which that might be May, maybe June. And during the 8-week period after that, you're at full staff. Even if you don't have patients filling your chairs all the time, you're going to get the government to pay for your staff while they're there for really 2.5 months, because that's how you calculate the amount of the loan is 2.5 times your average monthly pay. So that's for if you're on a bi-weekly or a semi-monthly payroll, most of our clients are twice a month. That's 2.5 months that the government is paying for your staff. That money can be used for some other things as well, which I'll mention down here. But these loans have highly generous provisions. However, we don't recommend you apply until shortly before you are able to resume full operations according to your state's authorized timelines. Also, you must receive the funds by June 30th. So the latest to apply would likely be, I would think, early June. So admittedly, there's a timing element here. And I'm going to talk about that in step number 7. So stay tuned. But here are the provisions of this loan. What's the maximum amount that you can get? You get 2.5 times your average monthly payroll cost during the 1 year prior to the loan application. It excludes any individual staff wages in excess of $100,000 for a given staff. It also includes anything you pay for employer-paid health insurance and employer-paid 401k and retirement plan contributions. It does include your own pay as the owner. If you're an S corporation or a C, you're receiving a W-2. It includes your spouse W-2 and as well. So it just doesn't include any pay in excess of $100,000, however. So the required use of the funds, they must be used for salaries and wages, but that's not all. It can be used to pay your payroll processing costs. That's going to be MyPay Solutions, or if you're with ADP or Paychex, whatever. The cost of group health insurance, rent, payment of interest, not the principal, but the payment of interest on any mortgage or other debt incurred before February 15th, and utilities. So in other words, you're going to use that money, no problem. Terms 4% under and up to 10 years. Loan underwriting requirements, just that the business was in operation as of February 2nd. And most of you closed down your office, pretty much all of you, after February 15th, sorry, not 2nd, February 15th. So pretty much all of you, I would believe, were operational then. And you certify the uncertainty of the current economic conditions make necessary the loan to support the ongoing operations. Now here's where there could be an ethical issue. If you're sitting on $1 million in your practice, you're a hoarder of cash and you haven't wanted to do anything with that, do you really need to get a 7(a) loan to get you through this period of time? Well, in a way, you're sort of penalized in this sense for having cash on hand, or but that's your call. That is your call. But that's what you have to certify, is that the uncertainty is so significant during this economic condition that it's necessary for you to take out this loan to support your ongoing operations. Also, you certify that funds are being used to retain workers, make loans and lease payments, rent, or utilities. And you have to have a reasonable credit score. I have no idea what the SBA is considering a reasonable credit score, but they do look at your credit score. Because again, other than the grant, you are supposed to pay back I'm sorry, that's the EIDL loan. The SBA loan, if it wasn't used for those purposes, theoretically, you would have to pay it back. So they want to know what your credit score is. All right, amount of the loan that can be forgiven is the amount used for qualified expenses listed over here in column 2, as long as you use it for those. And then it's reduced for any reduction in total staff during the 8-week period after you get the loan relative to a prior period, which there's actually a couple periods. One of them is in the prior year. And then it's further reduced if any of your individual employees see a 25% or more pay cut, which I suspect you wouldn't be doing that. So really, this is the big one here. Let me also emphasize that these 7(a) loans, these SBA 7(a) loans, as I stated earlier, these are totally separate than the EIDL loans, the EIDL loans, which you're getting directly from the SBA website. These are all received from a bank. The government is distributing a whole lot of money here, and they're using banks as their channel to administer these loans. They're simply guaranteeing these loans, and they're paying the bank's money to process these loans. As of today, March 30th, Monday, the banks have not started taking SBA loan applications based on the new CARES Act. I've reached out to all the big banks today, and they all said the earliest I heard was possibly this Wednesday, which is April 1st. A lot of others are saying by Friday, or I think most likely the reality is it's going to be sometime next week, the week of April 5th. And could you apply for that at that point? Yes, but remember, you want to make sure you're open for business legally. The health officials have allowed that, and your staff are fully on board before you get that money. So be careful not to apply too early for that. So the SBA regulations required that within 15 days of enactment, that was Friday, that the banks be ready for this. Hence, it's possible that lenders could begin taking loan applications as early as later this week. It really important, only work directly with your lender on this, or a bank directly. Do not find some Google form and start filling it out. There's a lot of fraudulent sites already out there, and they're designed to capture your personal information, possibly sell it or sell leads to banks, because banks will make money off of this, no doubt about it. Banks, they're not charitable organizations, and they're not in it if they're not making a profit from loan origination, which the government's going to pay, and from interest. And so be careful on which forms you fill out. It should be directly from the bank. So here's your action step. Go ahead and estimate the amount of loan you'll be eligible for by completing the table below. This is just to get a general idea. You don't really need to reach out to us CFOs unless you really need the help, but what you could do is just look at your W-2s from last year, or heck, you could look at your W-3. It's in your MyPay Solutions portal. The W-3 is the sum of all the W-2s, and just use that number, less any payroll that was above 100,000. So if you paid yourself as the doctor 200,000, you would need to subtract out from your W-3 $100,000. Most likely you didn't have anybody else on payroll making over $100,000. If you did, you would need to subtract the excess of their pay over 100,000 also from the W-3. The interesting thing about this is if you have a 1099 associate, an associate that's not W-2, they're an independent contractor, you can include them in calculating the amount of loan that you're eligible for. That was pretty cool. Of course, it's up to $100,000. Total employer contribution to a group health plan. So there you could simply get from your health insurance provider what you paid in premiums in 2019. And if you're paying for 50% as the employer, just take 50% of that amount. And then on the 401k as well, if you simply look at your 2019 tax return on the main page, it will say contributions to a retirement plan. There's your number. Alternatively, you can reach out to Brandon Hobson, our Director of Investments, and he could tell you that number very quickly. So then you add up all those boxes, and you have a total divided by 12 times 2.5, and that's the amount that will ballpark you will receive as eligibility. So let's take an example. Let's say that your total staff last year, you can see my calculator here, your total staff costs last year were $500,000 and you were paid $150,000 of that, and you were included in that $500,000. Well, you were paid $150,000, so we have to subtract out $50,000 because remember, you can only use up to $100,000 in compensation. So you're at $500,000 less $50,000 equals $450,000. Let's say that you also paid and let's say you didn't have an independent contractor associate, you paid your group health plan, and let's say you paid $20,000. So plus $20,000 equals $470,000. Your total employer contribution to the 401k, let's say that was 20, actually, I mean, that's going to include employer contributions to yourself as well. So let's say that ends up being $50,000. And so now you're at $520,000. Divide that by 12 to get your average monthly and multiplied by 2.5, which is what the law states for the 7A loans, and you're at $108,000. That is potentially $108,000 of purely free money. Now it's free to you right now. Don't get me wrong, we'll all be paying taxes for it later, but this will be free money to get you through this period, as long as you immediately hire your team back when you get the funds. So that is a healthy amount. It's going to be likely a lot more than you're going to be eligible for under the EIDL loan. Really important comment on this is that if you got the EIDL loan, then you need to refinance that into, you'll want to refinance that into the SBA 7A loan. From my understanding, you can't have both. It's my understanding, could be wrong on that, but you can't have both. So you want to refinance it into that. So let's say you had, going back to our example, let's say you had $30,000 of SBA EIDL, the EIDL loan, excluding the grant, $30,000 of loan, you would add that to this number, plus $30,000. So here's the amount of the 7A loan, is $138,000. Of course, the amount you'll receive will be less that $38,000 because it's refinanced, or it's eliminating the EIDL loan that you already received. So you would have an SBA loan of $138,000. You'll land in your bank account $108,000. The $30,000 EIDL loan disappears, and you're left with just one loan and $108,000. Okay, coming down here, determine if your primary bank is an SBA lender. So here's the next action step. Go to your primary bank. If you're with Bank of America or Wells Fargo, or Citibank, a lot of great banks out there, First Citizens, so many good banks. Ask them if they're an SBA lender. Every one of those banks I just mentioned is an SBA lender, and they're all working on getting the applications ready. Some of you might be with Lendeavor. They are not an SBA lender. So simply go and ask your banker. Good chance that they are already, and just use them to get the SBA loan. If they're not, then you can go to another bank, and the other bank's going to be happy to do it, because these are non-secured debt, meaning they don't have to have a first UCC or lien on your practice. It's really an unsecured debt, and so the government's backing it 100%. So most banks are going to be happy to do this. So this is true even if you don't need all of your staff. By doing so, you're maximizing the amount of forgiveness you'll be eligible. It must be applied for. See, this is actually wrong. I apologize. I need to make a change here. You have to receive the funds by June 30th. So I will come back and change that. All right, step number 7, upon receiving the 7A loan proceeds, make sure you've re-engaged your team at full or close to full capacity to be eligible for the highest loan level of loan forgiveness. As stated, this is really important, as stated above, because the amount of the loan forgiveness is directly and only correlated to your staffing levels and pay. Remember, you can use it for rent and you can use it to pay utilities, etc. But the amount what's determining the amount of forgiveness has nothing to do with your rent or your utilities. It has everything to do with the number of staff members you have on hand when you get the funds and how much you're paying them. It's critical that your team is re-engaged at the time of receiving the 7A loan proceeds or immediately after. Timing is important. Ideally, you would receive the 7A loan proceeds and hire a staff the exact day your state authorizes you to resume practice operations. Admittedly, that may be difficult. We therefore recommend you engage enough staff to meet your patient needs on the day you reopen doors. Then, immediately upon receiving the 7A loan, which should be after you actually reopen doors and are back in action, then you get the 7A loan. At that point, you re-engage any remaining staff. If you permanently terminated an employee during the office closure and plan to hire a replacement, it would be best to do so quickly, thereby, 1, taking advantage of the high number of people searching for jobs right now and giving you more access to top talent, and 2, getting you back to full employment for purposes of loan forgiveness. Also, remember that you can use these proceeds of the 7A loan to cover your payroll, rent, interest on loans, and utility. All right, so here's your action step. Re-engage your full team, if they are not already, at the time of receiving the 7A loan proceeds, which should be after you open your doors back up for business. This assumes your state has authorized you to do that. Step number 8, complete applications to provide loan forgiveness after the 8-week period. So let's run a hypothetical. Let's say May 1st, you're back working in the office. You apply for the 7A loan. You receive it on, let's say, June 1st, and you've now rehired your staff fully at that point to the same levels as they were a year prior. And now from June 1st through July 31st, that is the period, that's the key period where your employees need to be at full count, at full head count, because that's the period where they will measure whether or not you retained your employees. Keep in mind, that 7A loan is also called, literally, the Paycheck Protection Program, the PPP. That's in the bill itself. So the whole purpose of that is for you to rehire your staff and protect their paychecks. Okay, so how do you calculate that amount? Well, when you get the application at that time, and we don't have these applications yet, it's going to be a while before we see the loan forgiveness applications. It's going to be a while, but when we do, it'll outline that for us. But conceptually, the amount that's forgiven is the amount of 7A loan you received, which we showed you up above, times this quotient, this number. And that quotient is your full-time equivalent staff. FTE stands for full-time equivalent. And all that means is a part-time staff is not a full-time staff. If you have 2 part-time staff that are working 30 hours a week, we're going to call 30 hours full-time. If you have 2 staff working 15 hours a week each, that's 30 hours. Those 2 staff together equal 1 FTE, 1 full-time equivalent. Times your full-time equivalent during the 8 weeks after receipt of the 7A loan, divided by the full-time equivalent before. I'll state what before is here in a moment. Less the EID grant. So that's important. You can't get a forgiveness of the grant and a forgiveness of the full 7A loan. The total forgiveness amount is going to be the same. So if you already got a forgiveness of the grant, and let's say that was $10,000 and you got a 7A loan of $100,000 and you have a quotient here of 1, then you're going to be forgiven $90,000 and you'll have to pay back the remaining $10,000 on the 7A loan. So that equals your loan forgiveness. So here in the denominator, calculating the full-time equivalent, what is that? Before, well, it's February 15th, 2019 through June 30th of 2019. It would have been easier had they just said February 1st, so you don't have to figure out half a month there, but February 15th through June 30th, or January 1st, 2020 through February 29th, 2020. And the regulations say in the bill that you can choose, which is kind of cool because you want this to be low. The lower this, the lower we're comparing how much we've rehired our employees to what they were at, levels they were at before the crisis, the better. So a lower denominator equals a higher quotient. And so you can choose. I would run at the point in time when you're completing this application, I would run these both and see which one has the lower FTE, and you put that here. By choosing the one with the lower FTE, you're increasing the amount of the 7A loan that can be forgiven since the denominator in the quotient is lower. Note that the 7A loan received does not include the balance of an EIDL loan refinanced into the 7A loan. So this 7A loan received is excluding any amount of the EIDL loan that was packaged into this. So that's excluding that. Let's come and look at a couple examples. First, let me explain FTE. I sort of explained what that was earlier, but here's some examples. You have 6 full-time employees and 3 part-time employees working 15 hours. So what's your FTE? Well, it's the 6 full-time, and then you've got 3 part-time employees, each working 15 hours. So if they're working 15 hours a week, that's 45 hours a week total between those 3 employees. So if you divide that by what we're calling full-time at 30, that equals 1.5 FTE. So 1.5 FTE plus your true full-time employees equals 7.5 FTE. And that's what you would then put here in the calculations of the loan forgiveness. So let's look at some examples. Example 1, you did not get a grant. However, you got an EID loan for $30,000, and then you got a 7A loan subsequently for $80,000. And so if you refinance, which you should, you refinance your EID loan into the 7A loan, your total 7A loan is going to be $110,000, 30 plus 80. And let's assume that your full-time equivalent quotient, so this calculation right there, is 100%, which simply means you fully rehired your staff. And so we're assuming that the EID loan was refinanced into the 7A loan, which I mentioned. So your 7A loan is actually $110,000. Then the answer down here is, using this formula up above, right here, is $80,000, the total amount of the SA loan before refinancing. We're going to take out the amount refinanced of, you know what, I have got this wrong. So glad I'm doing this. Here's how the calculation should be. So I'm gonna send out the guide. It's gonna make a correction here. This should actually be $120,000 less the $30,000 times 100%, which is gonna be $80,000 times 100% equals $80,000. So again, there's so much happening so fast and so real time. We're trying to get this off the press. I apologize for some errors here. The PDF that we'll send out with this video will have this updated because the total amount of the SBA loan is going to be the sum of the refinanced EIDL loan and the 7A loan calculated as 2.5 times your average monthly payroll. So let's go on to number 2. In this case, the only difference is you did get a grant, and it would be $120,000 less the $30,000 that was refinanced times 100% equal. Oh, and then you have to subtract out the grant of $10,000. So in this case, it would be your $80,000 less the $10,000 of therefore $70,000. So, and that sort of makes sense. Your 7A loan, excluding the EID loan, is $80,000. And assuming you rehired your staff, you're going to get all that back. And assuming you rehired your staff and you did get a $10,000 grant from the EIDL grant, then it's going to be $80,000 less your $10,000, which is $70,000. And then in a scenario, same scenario where you only rehired back 75% of your staff, it's going to be 75% of the amount. So again, I apologize for that. And I can't go back and do this full recording, but I think you understand the calculation there. All right, action steps. Once the 8-week period after receiving the 7A loan proceeds has elapsed, apply for the loan forgiveness. Calculate the 2 FTE periods mentioned above and select the one with the lower FTE. Work with your CFO advisor to select the appropriate terms on any remaining balance after loan forgiveness. All right, step number 9, file your 2019 1040 tax return by July 15th. The tax due date has been moved to July 15th. Although you could extend beyond that to October 15th, we recommend you file your tax return on time so you understand refund or tax, what your refund or tax liability is. I have to talk with our tax director. It could be that they're extending the extension. I'm actually not quite sure about that, but we'll find out. So this will affect your plans to achieve your desired working capital reserve. We need to know what you're going to owe for taxes for 2019 or any refund that you're going to get. So action step, file your return. Action step number 10, build your financial walls back up. As I stated earlier, never let a good crisis go to waste. Use this crisis as a time to realign your finances with your values. Experiences like this reveal so much about our relationship to money, how we prioritize our spending and our savings, how we prepare for emergencies, and how we prioritize our dollars. We should come out of this experience with a renewed desire to prepare for our financial future by spending less than we earn, building our working capital and emergency reserves, and making a plan for financial independence. So your action step is to do that. So we will be keeping you updated with our global emails. Go to practicecfo.com where we're continually updating in our blog section our questions and answers. We're going to update this document and post it there as well. We'll create a link for this webinar and put it there as well. And we hope it's helpful to you.